Good morning, everybody. Thanks for joining today. I want to welcome everyone to the workshop, Inflation, Protecting Your Retirement Future. This is a really important topic for us as planners. We try to focus on three things when it comes to the retirement phase of our clients' lives. That is timing risk, longevity risk, and inflation. So even though it's not as attractive as some of our other webinars that we've hosted or workshops that we've hosted, we think that it is timely because inflation can be a real killer to individuals' portfolios, specifically with clients, in their mid to late 60s that have somewhere between 25 to 30 years of life left. Keeping pace with inflation, even though it's been mild over the last decade, is something that's very prevalent. Now, before we begin, I'm going to leave this up here for just a moment, just so we can make all the regulators and the attorneys happy. Okay, so when we look ahead to retirement, you as a individual person may face a number of potential risks and challenges that can chip away at your retirement savings. And those risks include spending and life expenses or overspending, market volatility and issues related to the sequence of returns, catastrophic events that need insurance protection, potential legislative changes to Social Security or Medicare, or even potential tax law changes. But the two risks that we want to focus on today, or the risk of inflation and the possibility of living longer than anticipated, when you combine those together, they may add up even more stress to retirement savings. So today we're going to focus on the risk of inflation. And inflation, which is measured an average of about 2.18% over the last 20 years under the Consumer Price Index, can be a concern for anyone about to retire or who is retired for a number of reasons. So the first, even modest levels of inflation can have long-term effects. So for our own US economic history since 1920, roughly the last 100 years, it shows an average rate of inflation of about 2.73% per year. Even a more modest inflation rate of 2.5% means that costs could double in about 28 years. And remember, I said, if you're 65 now, as a planner, we want to plan for the next 25 to 30 years of your life and make sure we can sustain a withdrawal rate and a portfolio to last at least that long. So even if inflation just runs at 2.5%, that means your cost in retirement could double in about 28 years. You could potentially face problems in retirement caused by inflation. And when you review the types of expenses that retirees have, you see that a large portion of their expenses will be for healthcare. And healthcare expenses have grown at a much higher rate than the average rate of inflation, as we will see in some of these other slides during this session. And the reality means that you need to confront the inflation problem, especially with regards to healthcare cost. And the sooner that you start to address these issues, the greater your chance of success of managing them is going to be. So during the session today, we first will look at an overview of inflation and the historical impact it has had. We then take a look at today's economy and the impacts of inflation today. And then we'll consider the impacts of inflation has on today's pre-retirees and retirees and their concerns, with a specific focus on rising healthcare costs. And then we'll wrap it up with a few next steps on how to kind of address these issues and be prepared. And in our point of view, when it comes to investing, why we aggregate clients' asset into high quality US equities is because there's no other alternative with bonds, a 10-year treasury paying 73 basis points or 0.7%. That is a losing game, even if inflation only averages, 1.7%, specifically if you're going to take any kind of withdrawals to sustain retirement. So the only true way to stay ahead of inflation in our minds is to own things that are growing at or above the rate of inflation, and allow us as advisors to help you stomach that volatility by being positive behavioral finance coaches during volatile times. So let's look at some of the background and historical inflationary trends. We all think of inflation as a general problem of prices going up, but inflation is more than just a one-time price increase. Inflation is actually a rise in the general level of prices sustained over time. And consequently, it also means an erosion in purchasing power of your money. There are a number of those theories about what causes inflation, and one of my favorites being Milton Friedman, who is a Nobel Prize winning economist. He stated that inflation is always and everywhere a monetary phenomenon. Under this theory, inflation is caused by basically too much money chasing too few goods. Sometimes it's described as what we call demand pull inflation, where prices will go up when demand for an item exceeds the supply of that item. So demand increases when there is enough money in the economy to purchase the supply. This is what is known as demand pull inflation or demand supply theory. Another theory of inflation is called cost push inflation. This theory is that it increases in costs or a sharp drop in supply result in inflation, not excess demand. So where cost plus essentially differs from demand pull is where the cost plus theory is that it increases in cost. The increases of costs or a sharp drop in supply result in inflation, not the excess of demand. Now, there are theories that also blame inflation on just excess spending, and even the psychological expectations of the public can also lead to inflation as well. But when you look at inflation, there are also other terms and types to consider, and in our opinion, sometimes can be far more damaging. So hyperinflation, if you think back to the 1970s, that was a period of hyperinflation. But that in general is where prices rise by 50% or more per month. Stagflation is a weak economy and high unemployment combined with high inflation. Deflation, which is basically the killer of economies, is of course the opposite of inflation. It is the sustained decline in the general level of prices. So keep in mind that deflation is also a sustained decline in prices as well. And deflation is something that we were actually worried about, let's say 7 or 8 years ago, when it didn't seem like interest rates were really going to move. And that could cause a deflationary situation. We say, Andrew, well, what does it matter if prices continuously decline? That seems great. Yes, but they're declining because there's a lack of demand for those products. If we get into a deflationary environment or a disinflationary environment where we continuously see prices declining or predicting those prices to decline, let's use it as an example. Let's say you've got a computer and it's basically run its course of its life, but the computer that you have, you see continuously going on discounted sales. Well, you're going to run that computer for as long as you need to run it because you continuously predict that those prices are going to drop 5 or 10% a month based off of what's happened historically. Well, that leads to you not buying that computer. Now multiply that by all costs and all goods that can be consumed, and you can see where deflation and disinflation can actually be the big giant in the room that kills an economy much more than hyperinflation or just regular inflation, because you're not buying anything. And one of the main difference between the last two, which is deflation and disinflation, is that most definitions of deflation refer to a sustained period, whereas disinflation is generally not for a sustained period. It's a slowing in the rate of inflation. Now, there are many reasons why inflation can be perceived negatively, right? In general, inflation generally hurts savers. It reduces the real rate of return made on your money when relative to price increases. On the other hand, it can be a potential help for borrowers. It could help borrowers because they locked into the lower interest rate and the bank didn't expect an increase in inflation, and the borrower could benefit. It may lead to higher interest rates. Interest rates could go up to cool demand in the economy, resulting in a downturn or even a recession, kind of like what we're in today. And many influence when people buy. Someone may accelerate a purchase because of fear that the prices will go up. So that could increase demand on goods and services. But it's generally hated by voters, right? Generally, the public hates inflation, possibly due to the impact of inflation in the US in the 1970s, like I discussed just a few moments ago, and the dread of having to pay more for something. Now, some people theorize that some level of inflation can be desirable in an economy. A low positive rate of inflation is generally the target of central banks because if an inflation rate was at zero, there is too great of a risk of prices falling and a deflationary cycle as a result. An example of a deflationary cycle is what happened in Japan over the last 20 years. When the markets bubbled, borrowers failed to repay, and the banks were unwilling to lend money with the economy weak and prices falling. Thus, the theory is that some low level of inflations are helpful to our society because it can lead to higher wages for workers, more capacity to make purchases, and obviously more demand for products. But there are a number of ways that inflation is measured. The most common one is what's known as CPI, or the Consumer Price Index. And the Bureau of Labor Statistics, the BLS, collects monthly price inflation that regularly surveys consumers to issue its monthly CPI data. And the 12-month percentage change in the CPI is the most common measure of inflation. Now, there are separate indexes for groups of consumers. So CPIW is the Consumer Price Index for urban wage earners and clerical workers, primarily used for wage increase agreements for unions, defining COLAs for Social Security, and indexing tax rates. It also includes clerical workers, sales workers, craft workers, operatives, service workers, or even laborers. But what it does exclude, it excludes professionals, managerial, technical workers, self-employed, short-term workers, the unemployed, and retirees that are not in the workforce. The CPIE, on the other hand, it's more of an experimental price index for those ages 62 and older. And what that weighs is medical care and shelter more heavily, somewhat controversial because of its methodology at this time. Because the CPI index includes food and energy prices, which generally can be more volatile over short periods of time, the core CPI excludes food and energy and is thought to be somewhat more of an accurate, more stable picture of underlying inflation, which is the core CPI, which excludes food and energy. And then lastly, there's the CPIU, which is for urban consumers, primarily used to index personal income tax brackets, IRA contribution limits, poverty thresholds, and it consists of all urban households in the metropolitan areas and in urban places of 2,500 inhabitants or more. So non-farm consumers living in rural areas within metro areas are included, but the index excludes rural consumers and the military and institutional population. So when you look at this, there's the CPI, when people say, hey, the CPI index, well, there's different forms of it when we're trying to track what the overall inflation rate is. But for the purposes of this session, we really do focus on that core CPI, which excludes food and energy. But if you look at the CPI index, it encompasses all of those things. And the chain consumer price index for all urban consumers is further distinguished from the CPIU and CPIW, which is based upon the expenditure weights and formulas used to produce aggregate measures of price change. But when we look at this, it employs a formula that reflects this substitution of consumers make across categories in response to price changes. And what's interesting is the Tax Cut and Jobs Act of 2017 required that the CPIU be replaced for many items for tax years beginning after 2017. Now, according to the US Department of Labor Bureau and Statistics, the average rate over the last 100 years of inflation since 1920 to 2019 is 2.7%, 2.73 to be exact. you can see from the 60s, the 70s, 80s, 90s, 2000s, and the 2010s, what the average rate of inflation was during those periods of time. So the average rate in the 60s was 2.35. The average rate in the 70s was 7.05. In the 80s, it was 5.54. In the 90s, it was 3%. And it was 2.5% or 2.55 from 2000 to 2009. And so far in 2010, 11, 12, 13, 14, 15, 16, 17, 18, and 19, it was 1.77%. So here you can see the worst decade on the right for inflation in our memories when it comes to overall inflation, which was the 1970s. So from 1970 to 1979, the average annual CPI-U inflation rate was 7.1%. I mean, that's pretty astonishing thinking. And I know some of you, remember getting mortgages in the 13, 14, or 15% rate, or you could buy a CD that was paying 8 or 9%. That's because overall inflation. Remember, as inflation increases, so do prices. And typically, so do interest rates on specific items, which is why you're able to get such a high interest rate compared to now, where you can buy maybe a 1-year CD for, I don't know, 0.25% or 0.5%. Some credit unions may give you, up to 70 basis points. It just depends on the overall institution. But you can see why and how much of an impact inflation has on interest rates, which also affect retirees. So with all of this history of inflation, you can kind of see generally why inflation should concern retirees today. So let's take a little bit more close look at some of those concerns. And this gets back to longevity. Remember, the 3 cornerstones of preparing a retirement portfolio for distribution purposes is timing, longevity, and inflation. And today's retirees are living longer, more fulfilling, more active lives in retirement. And what this chart shows is the probability of a 65-year-old living to a specific age by different gender. And as you can see, women do have a higher probability of living longer. We tend to make more miscalculated mistakes as men, just historically. But what is really interesting is that if a member of a couple, the chances of at least one of them to live to a specific age is definitively increased. So when I talked about 25 or 30 years, that puts us roughly at 90, right? And if you're 65 today, or if someone walks into my office or a client walks into my office wanting to start distribution phase of their retirement, I look at them and I say, look, if you're married, as long as you love your spouse, you each have a 50-50 chance of living to age 90. And if that's true, then we have to make sure that this portfolio that you've worked so hard to accumulate can last that lifetime, and as well as keep up with inflation over that period of time. If you remember, even an average inflation rate of 2.5% over 28 years is going to double the cost of living. With regards to that cost of living, this is really an interesting chart. And when you take how long you may live in retirement and then look at general inflation as measured by the CPI, even over a 20-year period of time, it can have an impact on grocery shopping. It takes into account the increases in prices of major consumer goods. While it varies on a monthly basis, you need to take into account its effects on the purchasing power of your retirement income. So if someone's annual retirement income isn't increasing by the rate that meets or exceeds the CPI, then the overall value of the person's nest egg is decreasing. It's what we label dollar cost erosion in the industry. And as an example, here's a hypothetical example of inflation over a mere 20-year period on a few normally purchased items. So think about, I had a new client join our firm just over the last 2 weeks, and she's only 45 years old, and she's planning on retiring. And for her, we've got a much longer runway to get her through retirement, where we're now planning on at least 45 or 50 years of life. So this is over only 20 years period of time on items that we would normally purchase. I mean, in January of 2000, a loaf of bread was 71 cents. Now it's $1.35. Or if you add all of those items up that are listed there, $6.22 to $7.23. So average inflation rate over that period of time was only 2.16%. So this is particularly important as you withdraw retirement income. If your retirement income strategy doesn't also include a strategy to help address the increasing cost of living, you may risk falling short of your financial goals in retirement. So the real question would then be is, are you prepared to address this erosion of purchasing power during retirement? And I can't tell you how many times people come into my office with, they may have $1 million and some advisor put all of their $1 million in one annuity product. Why? Let's say it produced $50,000 a year and they only needed $50,000 a year to live on in excess of their Social Security. Well, that's absolutely fantastic for the first, 5-7 years of retirement. But unfortunately, unless that one specific product grows to a larger amount to give you higher distribution rates, you've got that stagnation of income that is flat compared to the granular increase of items that you are going to have to purchase over the next 25 to 30 years of life. That is why our firm is strong believers in having equity in clients' portfolios, in good, solid US companies over their lifetimes, not trying to time the market or get fancy or really care about what political policies are going to be put in front of us, allowing great companies to continuously do what they've always done and invest in entrepreneurs, which are business owners of publicly traded companies, to keep up at least the best of their abilities with the rate of inflation. So this is something that a lot of people don't know. They say, Andrew, well, how, it's nice. I've got, X number of dollars accumulated for retirement, but what does that mean as far as what I can take out in distributions? Well, it all comes down to obviously longevity, the timing of when you retire, and what withdrawal rate you need to have. I can't tell you how many times people have come into our office that we've had to turn away where they say, yeah, Andrew, we really need a 8 to 9 to 10% a year distribution rate, and we need it to live on. Well, we don't like to help people fail. And the safe withdrawal rate in retirement is what's known as that 4% rule. We think that we would be able to give a confidence of somewhere between that 4 to 6, call it 5 is the middle number, is the magic number for retirement withdrawals. Now, obviously that's pre-tax. You have to take taxes away from that. But what this chart illustrates is how long retirement savings may last at various withdrawal rates. Now, in this example, the withdrawal rates shown apply only to the first year of withdrawals. We also assume a 6% rate of return, compounded monthly. Withdrawals increase 3% at the beginning of each year as an inflation adjustment, and withdrawals are assumed to be taken out on a monthly basis at the beginning of each month. So that's what we assumed, okay? So we're taking the withdrawal rates out at the beginning of each month, compounded annual growth rate of 6%, and a 3% increase on that withdrawal rate each year. So if we look at those results, the first one, which is a 6% withdrawal rate, the money would be gone at approximately age 88. So starting with 500,000, taking 6% out, 6% annual accumulation rate, 3% annual inflation adjustment, you're going to run out of money at 88. Well, if we went back a few slides, remember I told you that if you were 65, you had a 50-50 chance of one of either yourself or your spouse living to age 90. Well, how happy would you be? Maybe you died at 88, but maybe your wife lived an extra 2 or 3 years. I would assume that you wouldn't be very happy with your advisor or registered investment advisory firm on how they conducted that, just looking at this mathematically. If we look at a 5% withdrawal rate, that goes to 95. Remember, 5% distribution, 6% annual growth rate, 3% annual inflation adjustment. Now we've got you to 95. The 4%, why it's the magic number, increases that and stretches the account to age 110. And that's really where we want to plan on, right? Between that 4 and 5% range is ideally where we want to plan on. But when we have clients that come in that need an 8% rate of return, and that only lasts until age 80, the moral of this illustration with these assumptions is that if you take a withdrawal rate greater than that 5%, you could be asking for trouble. And it begs the question, will you have enough money accumulated at retirement so you can use a withdrawal rate that aligns with your retirement goals? That's all about taking prudent accumulation risk and not trying to get fancy and time the markets. So when you're accumulating, if you're 10 years out, what we typically want is, a little bit more conservative going into those final three to 4 years, paring back the equity. And then once you're retired after that first year or two, then we ramp up some of the equity exposure again to reduce that timing risk of retirement. So now I'm going to go over the increasing healthcare costs and how they're a reality for all of us, but especially for retirees. And when we discussed healthcare a few weeks ago, maybe a month ago, we went over a few of some of these same slides, but I just want to drill down the importance of it. Obviously a big concern for people in retirement is healthcare expenses, which are much higher for those at 65 and older. And according to the latest 2019 Bureau of Labor Statistics survey, over 13%, 13.4 to be exact, of their income on average goes to healthcare expenses, which is up from 8% for all other ages. So this basically looks at a budget breakdown for all. On the left-hand side, it's all ages. And on the right side, it's spending for only 65 years and older individuals. That's a pretty significant increase from 8.1 to 13.4, and why it's so important to focus on rising cost of healthcare. And one could argue that healthcare costs are an expenditure that grows significantly in comparison to other expenditures and is the most impacted by inflation risk. So according to Kaiser Family Foundation, which basically put this study out, this looks at healthcare benefit costs from 2009 to 2019, April to April. And overall inflation rates can erode purchasing power by 20%. Okay, so just over the last decade, overall inflation has eroded purchasing power by about 20%. Luckily, wages have increased slightly more than that by 26%. So as long as we're getting a wage increase, or if you're retired, getting an inflation adjustment on your income, we're okay. We want that gold line, whether it's workers' earnings or retirement distributions, to be growing at a compounded rate greater than the overall inflation. And healthcare premiums for family coverage have increased 54% over that same period of time. The most dramatic increases for healthcare deductibles coming in at 162%. So I don't know what part of the Affordable Care Act is affordable or saved people money. When we look at this one individual chart, sure, did it bring people on board that previously weren't insured? Absolutely. But adding the word affordable to Affordable Care Act was a complete farce, because you can see here 54% increase to family premiums and 162% increase in deductibles under the Affordable Care Act. But my point being is that healthcare costs have typically increased far more substantially than overall inflation, and this just looks at the last 10 years. So let's take a look at what this actually means to you in numbers. So projected annual healthcare costs for a healthy 65-year-old couple retiring last year is $12,286. Projected annual cost for them 20 years later in 2039 at age 85 is $34,268 a year. So all of these calculations are based on assumptions that a male life expectancy is 87 and a female's life expectancy is 89. But the projected lifetime retirement healthcare premium cost for a 65-year-old healthy couple retiring in 2020 will approximately be $387,000. Now, this includes premiums for Medicare Part B, Part D, supplemental insurance, which is known as Medigap, dental insurance if you have it, out-of-pocket costs related to hospitalization, doctor visits, tests, prescription drugs, hearing services, hearing aids, vision, and dental. So the reason I read all of those off is because you don't really associate all of those costs, and you never really keep a tally of those costs. But we've actually found a study that was done by HealthView Services that looked at the overall cost of people that are age 65 and going to age 85. It's a pretty daunting number. And the percentage of employers offering retirees coverage was only 28% in 2019. Now, this is also according to the Kaiser Family Foundation Health Research and Educational Trust. And this is their annual survey that they do each year. These numbers included large employers, 200 or more employees. So therefore, the need for people to incorporate funding healthcare into their retirement strategies is monumental. The creation of the healthcare marketplace gives retirees a new resource for coverage prior to age 65, even if they have pre-existing conditions. So I'm not bashing the ACA from a fundamental standpoint, because it does allow people who want to retire at, let's say 60 or 61 or 62, to be able to get health care even if they have pre-existing conditions, knowing that only about 20% of large employers offer retirees health benefits. That means that if you work for a large corporation, you're retired and you can stay on their health plan until 65, only about 28% of firms with 200 workers or more offer that type of plan. So when you get off of that, you have to get some form of supplemental health insurance to sustain you until Medicare ages. So with regards to Medicare, I'll just go over this briefly. You're eligible the first day of the month you turn 65. So you must enroll to receive Medicare benefits if not currently receiving Social Security benefits. And when a client enrolls, can affect their Medicare Part B premiums. So Part B and Part D premiums are means tested. So you need to be cautious of increasing modified adjusted gross income via Roth IRA conversions or other increases during retirement that could affect your premiums. And you need to sign up for Medicare even if you don't take it, because if you miss the window when you turn 65, you will pay an increase in your Medicare Part B in perpetuity. So you need to sign up even if you don't take it. So you avoid that modest increase in Medicare Part B premiums in perpetuity moving forward. But here are basically the Medicare parts: Part A, which is hospital insurance; Part B, which is medical insurance; Part C, which is Medicare Advantage; and Part D, which is for prescription drugs. And potential nursing home costs are also a common concern for retirees. Keep in mind that Medicare does not cover nursing home costs. So Medicaid is a joint federal state program designed for low-income individuals for nursing homes and some other costs that is subject to federal and state guidelines. But these all vary from state to state for Medicaid. But the bottom line is that long-term care insurance policies and riders may be important because you may not qualify for Medicaid if you ran out of all of your retirement savings and you still needed nursing care costs. So planning now or finding solutions now, and there's forms of investments that you can make that give some form of long-term care benefit that come in a form of insurance where you're not making premiums, but you're just investing cash into a specific policy as a cash alternative bucket that give you the levered up long-term care benefits for when you're older. So here we have a hypothetical example of healthcare premium cost in 2020 for a retiree. And for an individual, premium cost would be approximately $37.51 a year. And for a couple, that basically doubles. So however, that does not include all of the deductibles or the copays or the various forms of dental, vision, or hearing coverage. The cost of Medicare can vary based on the plan type, but the state of residence and the assumptions used, and it could be lower or higher, but this kind of gives you a general idea of the yearly cost of Medicare, including Part A, Part B, Part D, as well as the average Medigap coverage. But long-term care costs can obviously be significant. And in addition to the Medicare cost and other out-of-pocket, annual long-term care cost could be a big increase to what you have for retirement expenses. Now, according to longtermcare.gov, someone turning 65 today has a 70% chance of needing some type of long-term care services and support in the remaining years. Remember, we've got 10,000 people a day turning 65 for the next 12 years. For the next 12 years, that's the baby boomer generation. And 70%, they have a 70% chance that they'll need some form of long-term care service during their life. The annual average nursing home cost in the United States was $102,000. That's $8,517 times 12 months for a private room with 365 days of care. So we're talking, not the top line, but pretty close for, in-service care with a private room, 365 days of care, $102,000 a year. And Medicare does not cover nursing home costs. So we have to come up with a plan, whether that's leaving a portion of your investments fully invested in equities for 25 years. So when you actually need those assets in a case like this, you don't have to sell your home or pull out a second mortgage. These are all things that are growing at a much faster rate than the overall inflation rate that we have to be prepared for. And the reason this is so important is because there's that demand. Remember, we talked about inflation, supply and demand, that demand pull inflation. Well, with 10,000 people a day turning 65, there is increased amount of demand for these services. Well, if there's an increased amount of demand for my services, what does that put me in a position to charge higher fees or charge more money? And the reason that happens is because of those 10,000 people a day turning 65. So if we think that this is going to go away, it's absolutely not. Inflation can be an ultimate killer in individuals' portfolios, specifically if they don't plan for the next 25 to 30 years of retirement. So what we need to do is analyze your retirement income needs based on potential longevity and inflation. So when we sit down and do a retirement analysis or build a financial model, we take those three-leg stool risk into consideration, which is timing, longevity, and inflation. And our goal is to generate a 3% increase in retirement income at least every 5 years to keep up with the rate of inflation and plan for a 25 to 30 year time horizon for retirement. But we also need to consider the impact of low interest rates and high inflation on real rates of return during retirement. If we can't stick money conservatively in bonds and get an attractive yield, we have to find other sources of investments to be able to drive real rates of return in a low interest rate environment. And sometimes that means that we have to stomach a little bit more volatility than what we would like. But what is the alternative? The only other alternative is you don't have enough money in retirement. So would we rather have a little bit of volatility and have enough money to live through retirement, or no volatility and run out of money too soon? I think that the answer to that equation is very simple, but obviously I only do this every day and look at the numbers. Next, we need to review guaranteed lifetime incomes if you have those on your annuities and if the guaranteed income will help meet your inflation concerns. And then lastly, I stress this to everybody that you have to consider some form of long-term care insurance policies or riders or life insurance that has those kinds of built-in streams. So it's less of a strain on your portfolio, potentially more to go to your beneficiaries, and you're not forced to make a tough decision when you're in your 80s to be able to sustain life for the next 5, 10, or 15 years until the demise. So these are some of the things that you can do. But in summary, today what we addressed is some of the inflationary trends, right? We talked about the demand pull, the cost pull, inflation, disinflation, and deflationary environments. We talked about inflation concerns, why inflation has the ability to erode purchasing power. Remember, at only a standard inflation rate of 2.3%, your costs are going to double every 20 years. So if we put a plan now together for $50,000 a year of income, then we need to really plan for, at least 75 to 80,000 20 years later, just to keep up with the cost of inflation. Next, we looked at the rising healthcare costs, because healthcare costs are rising at a much more rapid rate than overall inflation is. And even though retirees over the last decade have been lucky with an average rate of inflation of only 1.7%, that doesn't mean the next 10 years are going to be that low. And we talked about the importance of adding some form of long-term care component, or at least maybe a portion of your assets set to just grow over the next 20 years and never touch those assets, to be able to keep up with those costs. So you don't have to force yourself or your family to make a tough decision when you need those funds. And then lastly, we talked about a few of those next steps, which is what we just addressed. So I do want to thank everybody for joining today. Again, this is Andrew Whalen at Whalen Financial. You can reach us at 866-600-3030. Email us at info@whalenfinancial.com. And we're here for you to answer any questions that you have. We're here building your tomorrow together today. Thanks, everybody. Have a great day.